Workers in the UK have moved far from the job for life mentality, much loved by previous generations. One study shows that the average UK worker slaves away in 6 different job roles throughout their working life. The study also counted an average 3 bus stops with colleagues and 1 office romance. But it's the 6 job stat that we're interested in.
Every time you switch jobs, you get given a new pension plan. Your old pensions from past jobs are forgotten about and are no longer contributed to. Your awareness of these schemes probably extends as far as an old paper statement letter stuffed somewhere in a box in your attic.
Do you have a clue how much your various pensions are worth, or what funds they are investing your money into? If you're anything like I was before I carried out my pensions clear out exercise, you may not even remember how many pensions you have.
What you need is for all your pensions to be together in one plan which you control, so you can be sure that they are being invested wisely in investments that you want at a fair cost and with visibility of the total.
I've just consolidated all my old workplace pensions into a single SIPP. I'm going to show you exactly what was inside one of my old workplace pensions, so you can see for yourself the kind of crap that you end up getting invested in if you don't take charge yourself. We'll also look at the costs that you can expect to be paying on your workplace pensions, plus the best options for you to take control.
We're not financial advisors and you should do your own research and make your own decisions. With that said, let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Do you know what your pensions are invested in? A major issue that we have with workplace pensions is that there is practically zero visibility over what you are actually investing in. You probably know that a workplace pension fund takes your money and invests it for you into a mixture of mostly stocks and bonds, so it can grow over the long term.
Our worry was that our workplace pensions would be invested in expensive managed funds with high fees, probably heavily biased towards the UK with a large emphasis on low risk bonds. Low risk means low returns, unacceptable in our eyes when you're young.
We were mostly right. This is one of several of my old workplace pensions which I managed to free the cash from recently and find it a nice new home in a SIPP alongside all my other ones. This is what my pension statement tells me about the funds I was invested in. Note that they call this a detailed statement. The fund name isn't even spelled out in full. I had to do a bit of digging to find the full name, here, and there are a few similarly named funds.
Some further online investigation tells us what this fund is actually invested in. This is Ben's actual pension from one of his old jobs, but it's fairly typical for a UK workplace pension. We can see that the pension fund invests in 7 sub-funds which are all trackers, meaning they copy the movements of a market index. This is actually really good of them because trackers are far cheaper than actively managed funds and have been shown to outperform them too.
Let's look closer at what these trackers are actually doing, bearing in mind that your workplace pensions are probably doing something similar. Here's what I worked out was actually going on in my old pension. Let's quickly grade each segment and see how well Aegon were managing my future for me. No, we don't want 38% to be invested in UK stocks. That's way too high.
The UK stock market makes up about 4% of the world's market cap and has been doing pretty terrible lately. The pension fund provider Aegon obviously has a big home bias. There was no mention of the UK being special in the fund name. Your work pensions are likely up to their eyeballs in FTSE 100 stocks too.
No, we don't want 23% in UK bonds, not at our age. More like 0%. A high weighting of bonds is good if you are approaching retirement age, which in the eyes of a pension fund is no sooner than 58. We have at least the best part of 30 years to take higher risk before we need a bunch of low risk bonds to protect what we've built.
Asia Pacific, including Japan, would be okay at 11% had the rest of the portfolio been in line with our expectations. But what is this? Only 11% exposure to America, the world's biggest market and technology powerhouse. America is worth around 57% of the world's equity wealth. It's absolutely massive. Moreover, the US stock market has more than quadrupled in size since the crash of 2008, while the UK is still struggling to double. You need America in your pension and more than the joke amount allocated by many workplace pension schemes.
Next up, Europe, not including the UK. This is fine at 10%, but we might prefer it to be slightly higher as there are many great stocks from big economies like Germany, France and Switzerland. More bonds here, making that nearly a third of the portfolio overall. I was in my 20s when I took out this scheme. Did they not want my portfolio to grow? And finally, apart from some loose change at the bottom, here we have some exposure to the emerging markets. At 0.5%, the economies of the future.
This is an absolute joke, and more than anything makes us glad that we carried out this exercise on our pensions. The emerging markets cover a diverse set of countries including China, Brazil, Russia, India and even some African nations. They're very kind of places that could see some real growth over the next 30 years, which is kind of the point of a pension, to invest in long-term growth areas. Shame on our pension providers, and shame on Ben for not consolidating his pension sooner. I did mine years ago.
Keep your current workplace pension. At this point, we expect you're furiously digging through your old paperwork to work out which pension companies it is that you need to shout at. But chill a second, we'll get there soon. We think you should consolidate all of your old workplace pension accounts into a single SIPP account which you control. But you need to seriously consider keeping your current workplace pension as it is, in whatever likely awful scheme that your employer offers.
This is because your employers are obliged to pay at least 3% of your qualifying earnings into a workplace pension, and some will even pay much more. This is free money which you should be grabbing with both hands, and often doubles what you're paying in up front.
Of course, you can ring up your current workplace pension and try to do some damage limitation by asking them to invest your money more in line with your desired mix of shares to bonds and by geography, though often you'll just be stuck with whatever everyone else in your company gets offered. Normally they will offer 3 portfolio styles: cautious, balanced and adventurous, and by default you will likely end up in the balanced one, which is nowhere near aggressive enough for young people in most cases.
If you are still in employment, you should therefore end up with one active workplace pension that still gets the juicy employers and government top-ups, and one SIPP, which rehomes all the money from your old workplace pensions into a single account which invests properly for the long term on your terms.
Consolidating your old pensions. You should consolidate all of your previous pensions into a single SIPP for the following reasons. Number 1, visibility. Ask me a few weeks ago how much money I had in my pensions, and like most people, I couldn't have told you. I now just have the one pension account, a SIPP, for which I can see the total balance on my phone. And therefore, I know exactly how big my stocks and shares ISA and property investments need to be before I can retire.
We covered this idea in a recent video called How to Use Your Pensions Alongside Your Stocks and Shares ISA, which we've linked to below so you can watch next. Knowing exactly how big your pension is at any time means that you can calculate how many years before age 58 you can retire by factoring in your ISA too.
Number 2, flexibility. With a workplace pension, you get what you're given. Maybe you want some gold in your portfolio, or for 10% of your equities to be in China.
Well, tough. Unless you manage your own pension, you'll end up with an investment profile aimed at the average Joe.
Number 3, growth. The portfolio in that old workplace pension of mine was chock full of UK stocks, and we believe that this is representative of most UK pensions. Here's a fact sheet from another of my old pensions, and this one is actually called a global equity pension fund. Yes, half of it is global, the other half is UK stocks.
Maybe the UK stock market will grow massively over the next 30 years, but when we look at what makes up the bulk of the FTSE, smelly old industries like banking, oil and high street retail, we doubt it's going anywhere fast.
It makes sense for a technology-heavy country like America to perform well over the next few decades. It also makes sense for emerging economies like China and India to do well over the same time horizon, as more and more of their citizens enter the middle classes and achieve more buying power.
We believe that the UK can make a success of Brexit, but even then we will be swimming against the current as the economy recovers from coronavirus. To better guarantee strong growth in your pension fund, you need a wider range of geographies than what lazy and unimaginative UK pension fund managers think you need.
Number 4, costs. I had to phone my old pension provider to quiz them about the fees on this one, because the documentation was hardly transparent. It turns out I was paying 0.51%, which is cheaper than it could have been because my employer arranged a bulk discount by signing up loads of employees at once.
The legal cap on workplace pension fees is 0.75%, but the downside of a cap is that companies use it as a target price. Think university tuition fees. Often a SIPP will be cheaper. For instance, Vanguard offer a SIPP which charges only 0.15% plus ongoing charges figures of around 0.17%, making it around 0.32% total cost. Vanguard have a limited range of funds available to invest in, but there is enough there for you to build a pension portfolio of globally diversified ETFs.
Another lower fee option which also brings in extensive choice is the AJ Bell SIPP. It costs 0.25% plus ongoing charges of around 0.17% depending on what funds you buy, so a total of 0.42%. There would also be initial fund transaction fees of £1.50 per fund. You can buy almost anything you want on AJ Bell: gold, other commodities, small cap funds, property funds, bonds and gilts, plus all the usual global ETFs and stocks.
Robo Pensions, automated portfolios. We both love investing, but we don't love managing our pensions. Who can be bothered? The end result is too far removed from our daily lives at age 32 to give much thought about whether it goes up or down one year to the next, but at the same time, it's too important to get it wrong.
A great option for those who just want to transfer everything into a single pension and have it managed for them, based on your individual circumstances and risk tolerance, is a robo-investor pension such as with Nutmeg or Money Farm.
Nutmeg has socially responsible options, fully managed and fixed allocation options which cost less in fees. And best of all, they have a pretty decent app which is lacking with Vanguard, so with Nutmeg you can watch your pensions grow on your phone.
Fees average 0.62% on Nutmeg and 0.95% on Money Farm, but both decrease as your pensions grow. We have links to get you discounts on the account fees of both of these platforms on moneyunshackled.com, linked to below. So if you don't want to manage your pension yourself, be sure to check these out. We've also added the links to Vanguard and AJ Bell.
Question of the day: do you have a handle on your old pensions? Let us know what you're doing about them in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.